Welcome to the Source of Commercial Real Estate, where we discuss all things non-residential commercial real estate, including finding and funding deals, seeking opportunities, and discovering your competitive advantage. I'm your host, Jonathan Hayek, and today I'm talking with Zach Alms. Zach is a seasoned real estate investor with over a decade of experience in the industry. His passion for real estate began at a young age when he started handling property management and maintenance duties for his family's small multifamily units. This early exposure laid the foundation for Zach's career, and he hasn't looked back since. At just 20 years old, Zach embarked on his own investment journey with a single family home, renting out spare rooms to offset the mortgage. And from there, he progressed to a 4-unit, 8-unit, and 12-unit apartment buildings before ultimately focusing on commercial real estate. He now specializes in retail strip centers and has a keen eye for identifying high value investment opportunities. As the founder and managing partner of 507 Capital, Zach is responsible for acquisitions and asset management. He takes great pride in his ability to create value for his investors by leveraging his deep understanding of the real estate market and his extensive network of industry contacts. Zach, it is great to have you. How are you today?
I'm doing great. Thanks for having me, Jonathan.
Of course. Really excited for this conversation. Really looking forward to all the value that you have to share with us today. Why don't we start out with you telling us about your background, aside from the intro that I just read, and what your work in real estate looks like today?
Yeah, so my bio told you a bit about me, but basically, when I was still a teenager, my parents had gotten into a couple residential or some apartment complexes, and I somehow took on the responsibilities of being the handyman and the maintenance guy, and so was doing that for a couple of years. Then graduated high school. I actually went to Australia for 9 months. Took some time off. And then I came back home and I needed somewhere to live. So I bought a house with the intention of renting out the rooms to my friends. Well, after I bought the house, my friends didn't actually want to live with me, it sounds, I guess. So I ended up renting out the rooms to random people I met on Craigslist and things like that. And did that for a couple of years and kind of got a feel for investing in real estate. Then I ended up buying an eightplex, fourplex, 12plex, all through creative financing, and was self-managing for a few years, and eventually got just burned out on dealing with tenants and apartments and stuff like that. And so I made the decision in 2019 to transition to retail strip centers, and actually closed on my first property in 2020, March of 2020, just as COVID was shutting everything down. My lender, I remember sitting in the lending at the closing table, and my lender says to me, "How do you feel about closing on this property while a global pandemic is going on?" And I, I guess I should have cared more, but I was like, "Well, I'm just happy to be closing," and so we did, and we had a couple of hiccups those first few months, but got over it. And since 2020 and that first purchase, we've purchased three more retail strip centers, and I've offloaded all of my apartments and now focusing on retail strip centers with a value add component.
Awesome. So much there to dive into. I think you are speaking to a lot of people listening that are dabbling in small multifamily, maybe have some small commercial properties, but when they hear retail strip centers, they're like, that is so awesome. How do I do this? So there's a ton there in your intro that I want to hit on. So 2020, COVID hits, you're closing on your first retail strip center. And of course, now we have the benefit of hindsight. But in 2020, we don't know what's happening. Depending on when you closed in 2020, it could have been, sky is falling, or it could have been, this is going to pass. So tell me more about that first deal in 2020 and what your thought process like as you're closing on it and trying to run it during the pandemic.
So yeah, we closed on it in March of 2020, just as everything was literally getting shut down here in the States.
Wow.
And it was insane. I should have thought more about, I should have, if I was more experienced, I might have looked more into backing out of the deal or prolonging the closing and stuff like that. But it was my first deal, and I just wanted to do it. I just wanted to close on it and keep moving forward. So we did. We closed, and literally probably within a week or two of getting the purchase done, I got uh, mail from my tenants that said that they are not going to pay rent for 3 months because it was a dentist, and dentists were very much shut down. And so I had to figure out a way to make that work. I went back to my lender and asked for some interest only payments, and so I didn't have to kind of lower my monthly cost. And ultimately, we made it work. I had my other tenant in the building actually ended up sending me a letter that said they might stop paying rent. Both tenants were credit tenants and corporately owned and stuff like that. And there's almost no point in fighting with whatever they say. So I swung. I went with what they told me to do and made it work. And ultimately ended up actually exiting that um, about a year and a half, 2 years later, and both of those, and the property was worth a lot more, basically, even without doing a single thing.
So take me back to that conversation. Okay, well there's something to dive into. Tell me about that conversation with the lender. I find it a little bit funny that the lender is sitting there at the closing table with you saying, "Are you sure you want to close on this deal?"
Yeah,
And
I don't
I
think
think
so.
I might ask to the lender, "Are you sure you want to close on this deal?" So you end up going back and asking for interest only. Tell me about that conversation. So you're only a couple months into this purchase, and you're going back to the lender saying, "Hey, I know I just closed on this, but can I get some interest only period? I gotta reduce my payment here." How did that conversation go? Was the lender receptive, or was that a tough fight?
Yeah, so luckily, it was a pretty easy ask because everybody was asking for it at the time. It was, all a lot of property owners across everywhere were struggling. So I wasn't asking to defer payments altogether. I was just asking to lower my costs, and the bank still got their money. I was just not paying principal at the time. So I think it was a pretty easy ask. There wasn't really much conversation to it. I just asked, and they were like, okay, yeah. So
Did you find that in that instance, and maybe you can generalize it to other experience, that your lender or banker was more of a partner rather than an adversary, with an iron fist?
kind of say that, yeah. I mean, they definitely want the deal to work just as much as I do because they don't want the building back by any means. So they want to make it work for me as much as they can.
Nice. So you said that you exited that deal, you no longer own it, and you made a great profit on it with, I think you said, without doing anything. So walk me
Yeah.
through how you were able to manage that. Tell me about finding it and how you were able to exit it with such a great gain.
So it's kind of a good story, I guess. So the building had two tenants. It was actually, I guess I can probably say it was a Starbucks and an Aspen Dental, and then a vacant space. And I had bought the building with the intention to fill that vacant space, and then increase the value of the property by doing so. But what I learned after purchasing it is that the market I had bought in was oversaturated, and and COVID didn't help by any means to fill any vacancies. So, but what COVID did do is it increased the value of Starbucks drive-through locations substantially. So and I had no intention to sell a year and a half later, but I found another property that I liked that I wanted to see if I could take a run at. So I called up the broker and I said, hey, I want to try and make an offer on this building. I have this other building, this Starbucks building, and the I don't know what it's worth, but I think that I could sell it and maybe come up with some of the down payment for this new one that I want to buy. And he said, oh yeah, I know about your building because he does a lot of retail strip centers in this market. And he said, well, I think you could sell it for X and X, at 6.5 cap rate. And I said, okay, if you can sell it for that, then I can buy this other one. And so ultimately, what I ended up doing was actually a reverse 1031 exchange. I purchased the new building before I sold the old building, and the number that we sold it for was like really, really close to the number that he had just spitballed on a whim, and it all worked out. By the value add was just by compressing the cap rate. I didn't do anything other than ride out the market during a rough time, and the value increased by having the certain tenants that I had.
Did you end up filling the vacant space?
Never did, no. But what we did end up doing
Did you,
is,
when you were,
go ahead.
go ahead.
What we did end up doing instead of filling the space is when we sold it, we actually um, the master leased the space, meaning that we said that we were going to basically be the tenant for that space for 2 years. Um, I ended up doing it as a credit at closing, but sometimes you can do it as an escrow, and it's like escrowed over 2 years. Um, so that way that the new owner had the security of 2 years worth of rent for that vacant space. And so that also helped increase the value or the resale value at the time of sale.
Okay. So when you were purchasing this, did you know you were purchasing it at a higher cap rate than you would be able to sell it for?
I had no idea that I was going to be able to sell it for a lower cap rate. I thought I was buying it at a low cap rate, honestly. So that's why I liked that there was a vacancy so I could increase the value. I had no idea that the market was going to do what it did. So,
Yeah, and I think, I mean, it's I I mean this in the nicest way possible. There's some beginner's luck involved where you see a good opportunity and it sounds like a quality building with some excellent tenants, Starbucks and Aspen Dental. Starbucks is obviously a great tenant. Aspen Dental is, a national credit tenant, so I assume that that would be a good quality tenant to have. So on paper, it makes a lot of sense. Have two great tenants, and I would imagine that it would be easy or easier to lease up a space right next to two other great retailers. That didn't work out. It didn't work out for you. You weren't able to lease it up, but the market was generous to you, and you made out really well. So you hit on something called a reverse 1031, and I want to talk about two things there: the reverse 1031 and the master lease. We're not going to go into intricate details about a 1031. A reverse 1031, if I understand it correctly, is where you close on the downleg property first. You purchase the new property before the previous property closes, and you have to kind of partner with the title company in order to make it work, and then you have to get some sort of bridge debt, either hard money loan or some sort of other capital to bridge the gap until your upleg property closes. So, can you walk me through first? Tell me if I'm way off with the reverse 1031 and tell us a little more detail about how you were able to structure that reverse 1031 in order to make the new deal work.
yeah. So yeah, you explained it perfectly, Jonathan. That's exactly right. You buy the down leg before you sell the the up leg. And yeah, you need to come up with some kind of way to purchase the building before you have the 1031 exchange funds. So bridge debt or something like that is what you have to do. My lender ended up letting me do, I actually 100% leveraged the building I was selling before we sold it in order to come up with the cash. Um, and the property I was selling ended up selling 3 months after, well, 2 or 3 months after the other building that I had recently bought. So it wasn't like a really long term hold or anything like that or bridge, but it still needed, there's a lot of complexities to it. Let's just say that much.
And so then in order to get the up leg property, I sometimes I mix up the up leg and the down leg. I think I'm saying it correctly. In order to get the up leg property sold, you master leased the vacant space, and you explained that you did that so that the buyer could have essentially 2 years of cash flow and feel good about the purchase. That they're not buying a totally vacant space, that there is some cash flow. And I imagine that since you did it as a credit at closing, if they found a tenant for the space, then great. Then they have two tenants for that space for the 2 years. Can you explain more about why you decided to do that master lease option for that vacant space?
Yeah, so the reason we did that is it actually increased the value of the property by increasing the net operating income, meaning the cash flow after before before debt service. So we increased the NOI by doing that master lease and also compressed the cap rate, so there was a good fluctuation in the value. But it also was beneficial to the buyer because instead of doing it as a 2 year escrow, I did it as a credit to them, and they probably just had to come up with less money at closing to close. So it was kind of a win-win for everybody. The property appraised by doing that master lease. The property will appraise for what it needs to appraise for in case there's any gray area and stuff like that.
It makes a ton of sense. And it ultimately probably just comes down to crunching numbers. So you as the seller have to decide, how much you're willing to lease that space for, and then work with your broker to figure out, okay, how much is this going to decrease the cap rate, to compress the cap rate, and see if it ultimately makes sense. If you're, giving up $25,000 in order to make $100,000, that's a pretty easy decision.
Right.
I want to ask you, these are some advanced techniques that you're using. I've explored the reverse 1031 before, and just couldn't get. It's really the bridge debt that I wasn't able to figure out. So I want to ask you about this creative stuff. And so this was your first retail strip that you're doing this creative stuff on, and I know in some of your previous small multifamily, you had done some creative financing. And so tell me about how and where you learned to do this creative stuff and where the courage comes from in order to do this creative stuff to get deals done.
So yeah, the creative financing is okay. Stop. What was the question? I lost my track of thought. It's a great question. I just gotta think of how I'm gonna answer that. How did I come up with creative financing?
So a lot of times we hear about the creative stuff, the master lease, the reverse 1031. This is stuff we hear about on podcasts, in books, and blog posts and LinkedIn about people saying, "Oh, you can just do this. It's so easy." But then when people try to execute it, it's a lot harder to execute than it is on paper. It's hard to get brokers on board. A lot of times, the broker representing the other person just doesn't understand creative stuff. A lot of times the other party just doesn't understand if you bring up, oh, master lease, what are you talking about? When you're trying to do a reverse 1031 and you're trying to convince the title company or the lender to do this reverse 1031, they say, oh, we don't understand that, we don't know how that works. No, we're not going to do that. So I guess it's more of just like, talk to me about how you learn the creative ways to get deals done, and do you have to do any work convincing the other parties involved to go along with your creativity?
So how did I learn creative financing? I guess a lot of the creative financing I learned was through books and through just talking to people and just learning from others. The I've done a lot of contract for deed deals. I did a lot. That's how I did a lot of my first apartment complexes, contract for deeds, low down payments and stuff like that. Um, books, and it was before YouTube was probably super popular with all this information. Um, so that's kind of where I picked up a lot of the creative financing stuff. A lot of contract for deeds. I've bought on contract for deed. I've sold on contract for deed. I've done zero down contract for deed. Um, I've sold something on contract for deed and then had money to buy something else. And that was all my residential apartment building stuff. When it comes to the retail and strip centers, it's a little bit harder to do contract for deeds and stuff. That's kind of what I've learned. You can definitely do some seller credits and some seller carries and stuff like that to help offset your down payment. Um, when it comes to educating other parties, whether they're bankers or sellers or anything like that, there's definitely some education sometimes. A lot of sellers aren't very open to the idea of seller credits, seller carries, or contract for deed because they just want to cash out and be done. But there can be a lot of benefit to them. They can earn more money through interest over a few years, and it can also help offset their capital gains if they have a large capital gain. So uh, it does help to try and educate them, but still sometimes it doesn't actually get anywhere. Lender wise, you just have to find the right lending partners to do the deals with you. That the As long as there's some lenders that aren't willing to do stuff like that or be the lender, but there are lenders out there that will. What I've learned is the smaller community banks are the more aggressive ones, and they are more willing to deal with you on things like that.
Thanks for sharing. One more follow up with the creative stuff. When you suggest creative stuff, whether it's a master lease or contract for deed or seller credit at closing, something like that, how is it often do you often get a good reception and an open reception, or is it like for every 100 times I suggest something, it only sticks once? Do you find that in the commercial space people are more open to creative stuff?
Yes and no. You kind of have to feel it out. Whether if you're dealing with a broker that's representing the sellers, it's a little bit tougher. If you're going direct to the owners, you can definitely try and sell the ideas of creative financing, whether it be contract for deed, seller credit, seller carries, things like that. It's also important to, whether you're dealing with a broker or not, it's important to find out what the seller wants to get, what their ultimate goal is. Are they trying to make $1 million, or are they trying to make $500,000? Find out what that is. Find out what they owe and things like that, and find out what the price is that they have to hit. Sometimes it just won't work, but sometimes you can say, okay, well, let's pay your price, but then on top of that, you're going to do a seller credit or something like that. So you can pay a slightly higher rate, but um, get seller credits or seller carries to help offset some of the cash capital you need to close. The
Let's talk about your strategy as a whole. That seems like a great first retail strip center deal. You may have had some luck involved there, kind of caught lightning in a bottle, and the market worked out in your favor. But that, I assume, you're not building your entire strategy. Your future investment strategy, trying to catch lightning in a bottle. I know you're a value add retail strip center investor. So describe to me what value add means and how you add value to a strip center.
Yeah. So with the strip center, there's a few different ways you can add value. The main ways and the most common way is increasing the net operating income, meaning the money that the building makes. So we can do that by increasing increasing the rents on current um, rent rates for the tenants. We can do it through lowering expenses that the whole building has, or we can do it through leasing up vacancies. Those are the three main ways to increase the value, increase the NOI. You can also sell outlots if the strip center is on a large piece of land and there's a potential to sell off a portion of it or even build on it and um, rent it to a tenant. There's that potential as well. But those are basically the main ways to increase value on a retail strip center.
And how are you finding deals right now? Are these on market, Crexy, LoopNet? Are you door knocking? How do you find value add strip centers?
Yeah, so I mostly use Crexy and LoopNet, and I also talk to brokers a lot and often. Mostly brokers here in the Midwest. I'm in southern Minnesota, so I try and focus in the Midwest. And just talking to people is kind of the best way to find the deals. There are deals on Crexy and LoopNet and online and MLS. I'm also a broker in Minnesota, so I also have access to the MLS. But most of the deals I found are through broker relationships and on market.
If you have a vacancy in one of your strips, how do you go about filling it? What's your strategy for finding tenants?
Yeah, so first off, you want to make sure that you think you can fill that vacancy in that market. Some markets it just might be oversaturated with retail or oversaturated with vacant spaces. So you want to make sure that there's a good potential to fill that vacancy. And then you talk to the local leasing agents, the local brokerages, and get them on the job. My kind of plan is to find the hungriest or the most active or the guy that will work the hardest to fill that vacancy is kind of what you want. You can also what I like to do is I like to underwrite the about 2/3 of the market rent for what we're trying to do. So it also, by lowering rent, you can also fill vacancies faster too. And also be willing to to give the new tenant some tenant improvement allowance. It could be 5, 10, 15, $50,000 of money that they can use for their build out to improve their space to the usability of what they want to use the space for. So there's just a lot of ways to um, get tenants in there. But first, the biggest one is having the best local leasing agent. Is Yeah.
What are tenants looking for in a strip center? I imagine there are differences in strip centers in terms of the kind of strip that's going to attract different kinds of tenants. Like you're probably not going to attract a national retailer to a Class C with with bad traffic counts. So what factors, when you're looking at a strip, what factors go into your thinking when you're considering how easy a strip is going to be to lease up?
Yeah, so that's a good question. Basically, what we look for is good traffic counts on the road directly in front of the building. The accessibility, how easy it is to get in and out of the building. That's a huge one. Sometimes there might be huge traffic counts, but there's a frontage road that you have to be on for a mile before you get to this said property. So really good access, hard corners, stoplights, stop signs, something where it's really easy to get into the building is very important. Growing, it needs to be in a good market, growing market, safe market, and yeah.
What are some red flags that would cause you to not consider a deal? Maybe it meets some of your metrics, but something comes up and you see this certain thing, this red flag that says, "Nope, I'm out." What are those things when you're looking at a deal that makes you just move on to the next one?
Some red flags. So let's just say it meets all the metrics that like it hits the kind of returns I want there to hit. It hits all the metrics that I want them certain property to hit. The the red flags would be a city that is not growing. If I were too small of a city, I'm from small town Minnesota, so I'm okay with small markets, but I probably still won't go smaller than maybe 25,000 people, and it has to be growing. If the city is going down from there, I can't touch it. It let's see, accessibility is also really important. There's also capex issues. The building can be perfect in every way, except that it needs a lot of physical attention. And if you have to put in 100,000 or 500,000 or $1 million of capex in year 1 or 2, that's pretty hard to swallow. So that's a pretty big red flag.
Zach, I want to go back to your answer about brokers. We were talking about finding deals, and you talked about using brokers. You also talked about brokers when you were talking about leasing up spaces and wanting to find the hungriest broker, the hardest working broker. Tell me about your strategy in finding brokers. It can be challenging. It can be intimidating for a newer investor to have these conversations with brokers. So, what suggestions or advice do you have in having these conversations with brokers and finding the right broker that's gonna meet your needs?
Yeah, so talking to brokers can be tough. Biggest thing is just you wanna you wanna ask good questions. They they can be judgmental if you don't ask good questions, I guess. So just asking questions about the property, ask questions about the occupancy, the NOI, the market, the rent rates, and those are good things. If it's a credit tenant, are there any ask about how the lease is structured? If there's anything that the credit tenant put in that lease that might deter some buyers. Um, but basically, you just gotta pick up the phone and call. They're people too. They'll talk to you. And you just gotta learn the process of talking to brokers. Um, that's probably the best suggestion is just learn by doing. And that's how I've always done things is learn by doing. And yeah, you might make a fool of yourself the first few times, but you'll learn what not to say and you'll learn what to say. So that goes for leasing brokers and brokerage sales. So
Great advice. Yeah, I always think, at least now, in as we're talking in April 2023, brokers want to do deals. If they've got a listing, they are, at least from the brokers that I'm talking to, they are anxious to get their deals sold. It is harder and harder to get deals done right now with interest rates where they are, and certainly some uncertainties coming in the second half of 2023. Brokers want to broker deals, and if you I get brokers calling me, like a lot of times when I'll click on a Crexy, like a Crexy listing, if I click on the OM or the flyer or something like that, a lot of the brokers, they get notifications when you click on stuff. And so I personally get a lot of brokers calling me and leaving me voicemails and asking me questions and wanting to do deals with me. And so those are really good opportunities just to answer that phone. If it's an unknown number, answer the phone and just have a conversation. If you're not sure what to say, ask about the market, ask about if there's vacancy. Oh, how easy do you think it'll be to fill up that vacancy? What do you think market rents are for that vacancy? And just exactly like you said, Zach, just get good at asking questions. Brokers really pay attention to the questions that you ask and your knowledge about commercial real estate. And so, if you can show that you have some background and you're not a complete newbie, and even if you are a newbie, if you're faking it well and you're asking good questions, these brokers are going to want to talk to you and work with you. If not on this deal, the really good ones will ask, okay, well, if this deal isn't for you, what are you looking for? And I can check the database, and I can look for other deals that I have, or other deals that are available that might work for you. And so I think that's really great advice of just kind of get over some of that fear of talking to brokers, and just do it and ask some good questions. Zach, can you tell me about lending? I kind of touched on lending a little bit. You're buying these value add strip centers. Tell me about the lending environment, and do lenders have an appetite for doing these deals right now?
Yeah, I mean, it depends on what lender you talk to. There's a lot of lenders right now that aren't doing retail at all, or that have just pulled back considerably on lending out, lending. But there are definitely lenders and bankers still out there that want to do deals and want to lend you money. It's going to be, are they going to be doing it at the right interest rate or at the interest rate that you want? But sometimes it's worth just building a good relationship with a lender, even if they don't have the best interest rate. It's worth doing a deal with them because they are aggressive and they want to do deals. Sometimes the interest rate isn't the most important thing. Um,
So who are you looking to finance your deals? What suggestions can you have if someone has a value add strip or a value add anything? What sorts of lenders? What's the profile? Are you talking to credit unions, regional banks, small banks? Who would lend on these deals?
I would talk to the small local community banks, local regional banks. You don't want to get too big of a bank. Credit unions. Don't talk to the Wells Fargos and the Chase banks. They're not going to do deals like that. You want to talk to the smallest bank that maybe has one or two locations that you think can lend on this property. They're going to be the ones that are going to be more aggressive, and especially if they're in the market of the property you're buying, they're going to be your best bet because they want to lend on properties in their market. They want to lend to local buyers, and if you can do all those things and then maybe open a checking account at that bank, it's a win for them. And so they'll want to do the deal as long as the deal can, you know, cash flow, or you have the potential for it to cash flow, or if you have a good plan, they'll want to do the deal.
Zach, tell me what kinds of deals you're looking for right now. You're scrolling through LoopNet, Crexy. What is the ideal deal that you see? You say, "Yep, this is exactly what I'm looking for."
Oh, yeah, that the main thing we're looking for right now is value add strip centers, and so I'm always talking to brokers, trying to I'm telling them what I'm looking for. I want there to be, let's say 10 to 20 to 25% vacancy or more. If I can increase the value through leasing up a space, that's perfect. Um, when I'm scrolling through, let's say Crexy or something like that, and looking at offering memorandums, you got to sometimes look at the financial sheet and see if there's any discrepancies on the net operating income, where if you feel like the offering memorandum isn't, perfectly accurate, which they're not always accurate. There's You can find deals that way. um, and But yeah, basically things where I feel I can increase the value through leasing up a space or increasing the rents on current, it could be a fully occupied building, but I think it's they're way below market rent. Maybe they're at 50% market rent. If I feel like I can increase the value by raising those rents, then there's a substantial value add there. Um, and even like buildings that might need a little work, that don't look the prettiest, there might be some value add there. If it has a tenant in place, but there's some, it's just not the prettiest building on the block or in town. There's value by um, buying the building, fixing up the exterior of it, making it look good again, and then you should hopefully get some traffic to come and fill your vacancies. So there's lots of different ways to do it, and I'm looking for anything with value add. Well, I've made a lot of mistakes investing and stuff like that, but I like to, I've always kind of looked at it as optimistic view as, the making a mistake, I can learn from it and grow. So whether, I did a flip house once and we ended up making money, but I am never flipping a house again because that was horrendous. Just the amount of work that I put into it and the return, it just didn't make sense. So, I'm always making mistakes, but as long as I'm growing from those mistakes and learning from those mistakes, um, I don't know if I actually think of them as mistakes. Yeah, so you can find me on LinkedIn, Zach Alms, Alms is my last name, or you can go to my website, which is 507capitalgroup.com.